It's slash and burn at Credit Suisse. Chief Executive Tidjane Thiam has announced a brand new strategy after poor results, and it involves dramatic cutbacks in the investment banking business, particularly the most capital-hungry bond and currencies trading area. But the bank is also going to have to raise more than $6 billion to help pay for this. Why the cuts in investment banking? The move to cut investment banking is a strategy similar to that pursued by lots of others, especially in Europe. The main problem area is bonds and currencies trading, also known as macro, which through changes in regulation has become much more costly, and the low profitability there and low levels of activity are dragging down profits across the entire group. At Credit Suisse, returns were just 7% in the third quarter. So, is Credit Suisse going back to its private banking roots? Well, yes and no. Switzerland is going to be one big area of focus where the group hopes to lead consolidation among some of the smaller private banks, but the main investment and the main focus is going to be on Asia and emerging markets. The group thinks that global wealth is going to grow by about 50% to more than $94 trillion by 2019, and Asia and emerging markets are going to drive about 60% of that growth. So it plans to invest about 1.5 billion Swiss francs in building out its private banking, wealth management and investment banking services to try and capture that. Can investors look forward to great profits then? The devil is in the detail, and the detail is quite different to what investors will have seen before. There are some new headline profit targets for the 3 new business regions that the group is being organised along, and there's also a promise to generate up to 25 billion Swiss francs in cash, about 40% of which investors should get back as dividends. However, Mr. Thiam has refused to set any kind of ROE target, calling other bankers who have done such things as fools because they are always missed. It will take time for investors to work out exactly what the ROEs are going to be from this new plan, and in fact it might take time for those ROEs to really come through and finally beat the cost of equity, which is what investing in banks is really all about.